I think there's a number of tailwinds that are in our favor. There's a tailwind of national resiliency. There's a tailwind for national security. There's a tailwind for onshored critical minerals, for instance. We want to own our own destiny. We don't want to be reliant on other countries for materials and minerals, which are required to defend ourselves in many cases.
So welcome to this week's episode of Leaders on a Mission. I'm your host, Simon Leich, and really looking forward to this conversation. It's been in the offing for about the last 3 months. It was definitely pre-Trump that we first started discussing it. And I think really as the Trump administration really begins rolling back these climate policies, many are asking now, what next for climate tech? Can innovation stay on track when government support disappears? So very different conversation, Leo, but thanks so much for joining me today. Leo Banchik, Director of Voyager VC, to really kind of explore how investors are navigating this political shift and I suppose what technologies are resilient in a climate-denying administration and why the mission to decarbonize isn't slowing down no matter who's in office.
Yeah.
Right. So thanks, Leo. Thanks for joining me. I know you're a busy man, so I appreciate it.
No, it's all good, Simon. Thank you for having me on the podcast. I'd say, there are some challenges with the current political environment, but very much an optimist, and I think there are some policies that are actually very supportive of climate and the deep tech sector that we play in. Just to give a couple of examples, recently there was a $900 million capital allocation from the DOE that Chris Wright had announced for SMR, for small modular reactors, fission. There was recently an executive order for critical minerals, which calls for onshoring a lot of our critical minerals production, which is currently done overseas, sometimes in adversarial regions. And so, that's just a few, but there's a big push for deregulation, largely. And that can have some benefits in terms of reducing transmission and distribution, interconnect queues, so renewable projects can come in faster and come online, in more areas as well. There's, certain amounts of nuclear deregulation, when done properly, can, allow fuel rods to be transported perhaps more easily, as long as safety is still a primary consideration, right? I think that the benefit of deregulating nuclear is a positive one. And then if we address the drill baby drill mentality that the current administration has, that has some positive implications for climate as well. So if we think about geothermal, that's a drill baby drill, right? And carbon sequestration also to some degree, if you're storing in aquifers, salt saline aquifers, for instance, or let's focus on another one, geologic hydrogen. So in our portfolio, we have a stimulated geologic ammonia company, which will be drilling for particular regions in the US and around the world where there are particular rock formations that, when combined with nitrogen, water, and a small amount of catalyst, can produce ammonia without the need for Haber-Bosch, CapEx. That's also a drill baby drill. So I think that largely, Chris Wright is more of a free markets thinker, I believe. He was, before becoming the DOE energy secretary, he was, I believe, a board member at Oklo, which is a fishing company that's now public. He was an investor in Fervo, which is a geothermal company. And so, and both of those are considered to be, to some degree, climate investments, right? And so if he's a free markets thinker and we really let the free markets dictate what kind of technologies come into market, guess what you're going to see? You're going to see a lot of renewables. You're going to see a lot of batteries. And as all of these technologies, many of the technologies that I just mentioned come down the cost curve even further, you're going to see the energy transition. Now, this is something we believe at Voyager. It's something that I've believed for a long time. I've been in climate since 2006. The inevitability of these cost downs means that the energy transition is not one that requires altruism, but one that is driven by free markets and unit economics. So let me say a little bit more here. Solar is the cheapest form of electricity we've ever produced on this planet as humans. I love that fact. And you can just look online. I've got it on a blog post on my LinkedIn, or you can find me on the Next Descent on Substack. But solar has been consistently underpredicted over the last 10, 15 years on what what its adoption would look like. The forecasts have it coming out this far or this far in terms of gigawatts penetrated into the grid, and it keeps just coming up like a hockey stick, right? So it keeps beating those metrics, those forecasts, those predictions. Same for batteries. And we see that it's directly tied to cost down. Right now, there's a plummeting cost down happening for lithium iron phosphate (LFP) batteries, and that's just going to mean a lot more battery energy storage on the grid, which are used to balance renewables and create basically firmed baseload power. So, if you want any indication of how this is working, go look at Texas, which has a merchant market, and solar and batteries are just exploding within that ISO within ERCOT. So it's if you want to let the free market win, the energy transition, I believe, is inevitable.
Awesome, yeah. And do you think that, therefore, that initially there's a lot of kind of press and negativity towards some of the kind of executive orders and some of the kind of, the drill baby drill kind of narrative? Do you think it's been therefore a little bit kind of misinterpreted to a certain degree? And, there was a little bit more kind of fear and people kind of getting used to that. But as you've mentioned, you dig a little bit into it and there's quite a lot to be positive about, right?
Yeah. I mean, I let the unit economics speak for themselves and the cost curves coming down. I mean, the utilities and if you're looking outside the grid at commercial power, let's say for data centers, these are rational actors that are going to be looking at the lowest priced power for their PPAs. And they're going to be looking at low LCOEs. And in many cases, renewables plus batteries is where you want to look. Geothermal's coming down the cost curve. Fission, TBD, but there's a lot of investment right now in fission. And I say TBD just because other countries, like say China, know how to build fission very well. They've done the reps on building many of these facilities, and here in the U.S., these mega projects sometimes take a little bit longer. They go over budget or over time. That's been historically the case in the U.S., and that's why there's been a lot of investment in small modular reactors as well to try to take advantage of something I like to call economy of number versus economy of scale. Rather than going really big and building a gigawatt nuclear facility or a 2 gigawatt nuclear facility, you're looking at say 100 megawatts or maybe even 50 megawatts or less. And then as you pump those out, your cost curves come down and you can just, repeat modular blocks in order to create more power for the grid or for whatever consumer you've got.
Much quicker as well. Much quicker, I would imagine, getting online as well.
Yeah, absolutely. And so, there are a number of companies here in the U.S. that are well backed and are trying to chase that, and hence the 900 million I mentioned from the government. But I'd say, to answer, I want to make sure I answer your question. I'd say it's a combination of these kind of inevitable cost downs and just the fact that let's say for renewables or for nuclear, you are paying a one-time fee effectively. So like, what do I mean by this? For renewables, and I'm being very general here, right? But for renewables, you pay for the CapEx, and then you pay for, operations and maintenance over time, but you're not paying for the fuel. And that's where the levelized cost of energy, which takes into account O&M, CapEx, fuel costs, and all of the recurring outflows and inflows that you would see for a project. The levelized cost of energy is one of the ultimate KPIs or metrics used to determine which is sort of the favored technology to be deployed, and in many cases, we're beating. I say we, like the climate technologies are beating existing fossil fuels. So coal is quite expensive these days. I can't recall exactly the LCOE right now, but it's definitely above 10, 12, 13 cents per kilowatt hour. Natural gas, especially the large IGCCs, are lower LCOE, but gas is a very volatile market, and I think solar plus BESS is about 6 to 9 cents per kilowatt hour last time I checked. I think IGCCs are around 7 to 8 cents per kilowatt hour. These are constantly updated every year, by the way. But solar plus BESS is just going to get cheaper over time. We recently made an investment into a company that replaces silver in photovoltaic panels with a much cheaper metal, not yet public, but that will reduce the price of PV. Batteries are getting less expensive. We also invested in a company that uses second life batteries to for use in the grid or for use in commercial and industrial facilities. And those second life batteries are in many cases very much cheaper by a significant magnitude than the first life batteries. And so there are ways in which the costs are only getting better. Nuclear LCOEs, I know that there are going to be some listeners that are going to have different numbers here, but I'm referring to Lazard. I checked last year, so those numbers may have changed, but nuclear is, I think, a little bit more close to like 15 to 17 cents per kilowatt hour, but those numbers are going to come down over time as well as we, develop that muscle. We also invested in a company that can use biomass or natural gas into what's called an oxy-combustion reactor. And it's a far more power dense, more efficient type of Brayton cycle. Effectively, it uses supercritical CO2, so it's very high, very power dense. I know I'm throwing out some jargon, but it's they have the opportunity to have extremely low LCOEs, and there's a world in which the LCOE could be potentially zero because what they
Right.
do is they can actually produce carbon alongside CO2 alongside baseload power. And right now, we want to talk about the policies here in the U.S. 45Q is one of the provisions in the IRA, which is very likely to stay around. There's high bipartisan support for this provision in the IRA, and that has an $85 per ton carbon credit. And so, if you can rely on that 45Q, the company has economics that pencil regardless of whether you can monetize the carbon, but the carbon is a cherry on top and it's a very big one. So again, there are some positives, and I gave you a little bit of an indication on some of the investments we've made
Yeah.
on how we are investing in that cost decline and investing in what is effectively the inevitable future for how we make and consume power.
Absolutely. Were there some sectors, like when you looked at your strategy and the kind of areas that you invest post this administration, were there some areas you had to kind of scrap and move away from and decide not to go after, as it were?
Yeah, I think that companies that require altruism in their purchasing decisions, in their customers' purchasing decisions, will have a harder time, I believe. So in this environment, I think unit economics is key. The ability to generate significant revenues, having a very large total addressable market, having a fierce killer team that's able to navigate some of the political environments while also able to sell to corporate customers very effectively. I think those are the ones that are going to succeed the most. I think some sectors which have seen, which I believe may see some difficulty moving forward. Although there are some shining spots here and there are rounds that continue to get done for some of these companies. The one I've mentioned in other podcasts is direct air capture. I think it's an important piece of the carbon removal puzzle, but it is going to be more expensive based on first principles. So direct air capture, for the listeners that don't know, is a part of it's a form of carbon removal. And let me give a very quick analogy for your listeners. And you may have heard this before, but if the atmosphere is like a bathtub that's full of CO2, we both need to stop the tap, which is, continuously inputting more CO2 into the bathtub. But at this point, the bathtub's already very full and overflowing effectively. That's what's leading to our warming world. And so we also need to drain the tub. So turning off the tap looks like more EVs, more renewables on the grid. It looks like other forms of carbon neutral baseload power, like geothermal and fission that I had mentioned. But it also looks like carbon removal, and historically that's been a lot of nature-based solutions, folks planting a lot of trees. But it's also enhanced rock weatherization, bioenergy carbon capture sequestration, ocean alkalinity enhancement, which is pulling carbon out of the ocean. By far, though, the most expensive, I believe, and this is due to first principles, will be direct air capture. So you're
Yeah.
directly pulling carbon out of the air using a liquid solvent or a solid sorbent. And what do I mean by first principles? Just the carbon is the most dilute in air. It's still enough to change our climate, but it's at what, like 400 to 450 parts per million right now. And so it takes a lot of energy to be able to pluck a CO2 molecule out of a mixed gas like that. And so I think that there's a role for DAC, but given that it's the most expensive, there's going to be a flight to lower price carbon removal technologies. And currently, DAC also, in most cases, doesn't have a co-benefit. So in our company that we invested in that can do biomass or natural gas combustion and get CO2 while also being able to provide baseload power, they've got that co-benefit. They can sell the power and they can also sell the CO2 to the highest bidder. And in DAC, it's just the CO2 predominantly,
Yeah.
which you're selling to the highest bidder. In that case, the highest bidder may be the Frontier Fund, which has been doing great work on catalytic, what they call advanced market commitments. But that's a few companies that comprise Frontier, and it's not the broader market. So do I see small, medium enterprises buying carbon credits from DAC? Like my parents that have a small civil engineering firm in Las Vegas, they've done great work. But do I see these enterprises
Probably not.
buying carbon credits? Yeah, exactly. So that's what I mean by it relies on altruism to some degree. I still think it's important. There are great teams out there doing DAC, but it will face a little bit more difficulty to answer your question.
Yeah, no, absolutely. And it's interesting because you guys with Voyager, it's a relatively newish fund, right? I'm right in thinking 2022 was the first fund, right?
2021, actually.
2021, okay.
Yeah, started by Sierra and Sarah. But I should mention, and I want to let you ask your question, of course, but it's a newer fund, but we've all been in climate for a long time. So
Yeah.
it's between Sarah, Sierra, myself, and the team, we've got 60 plus years of cumulative experience in climate tech. And so we've seen what can work, we've seen what can't. We still try to keep an open mind. When we see somebody come to us with technology that's been tried before and failed many times, we try to ask, okay, is the why now strong enough to invest? But having that historical lens definitely helps. But go ahead with your question, Simon.
I was going to say a couple of things. So predominantly the fund is, I'm right in thinking, it's kind of a seed, kind of pre-seed, Series A kind of,
That's right.
Tends to be where you invest, right?
That's correct.
Yeah. And I'm just curious, 2021 and where we are now, like when you're deploying capital, how different is it? Like in terms of, how much more kind of rigor kind of goes in now to making decisions and deploying capital compared to maybe the heady days of 2021, right?
Yeah, where the market is a little bit different. In 2021, rounds were getting done very quickly at elevated valuations. Some of those companies are still around and doing well. Some of them are still around and have had their valuations reset, frankly, which isn't always the best for the earlier investors or the teams, but it's what's necessary. We've been very disciplined at Voyager in assigning valuations that we think actually reflect the business. And, given that we're past those heady days of the past, there's usually a little bit more time to diligence the company, develop a strong relationship with the founders, and get in at the right price. So when I think about, where we were before to where we are today, I keep thinking about, Warren Buffett, I believe, who said, when the tide goes out, you can see who's swimming naked. We've been very disciplined, and that's paid off for us over time. We continue to maintain that diligence as well, even though valuations certainly have come down and reset to something that's a little bit more normal.
Yeah, no, got it. I suppose as an investor at that early stage, what are your kind of main kind of concerns and fears about the future, as it were, for these companies that you're investing in terms of, kind of making it through, as it were?
I mean, we invest in companies that we have high conviction on around team, total addressable market, customer traction, unit economics, and we typically don't stack risk. So we don't like to stack technical, commercial, regulatory. We're fine with one of those in general. And so what I mean by this is like if the companies have tons of offtake, but they just need to optimize their technology a bit. And by tech risk, I don't mean going from a science experiment to a pilot. I mean, you're at a minimum what we call technology readiness level, which is usually between 3 to 4 is what I like to see. And what that means is that there's no scientific question on whether this can happen. It's sound technically, it's been demonstrated in the lab, and now it requires scale up, engineering, execution, perhaps some time, a little bit of R&D funding, but the first principles are there and they've been demonstrated. And so, in one example that I can share is we invested in a company that uses a protein for critical mineral separation and refining. They're starting with rare earth elements. They're planning on going into other metals. There is a huge amount of demand for onshored rare earth elements, just to pick that one as a start. And the company's tweaking their tech, going through rapid cost downs. Month over month, costs are coming down very quickly. And they've already got, they're lining up their first off takers here within the Department of Defense and other defense contractors. And so that's one where we felt like, the winds were in their favor commercially, regulatorily. There was a little bit more technical work to do, but they'll get there. And we're very bullish about that company. So and many of the companies in our portfolio, of course. But this is to say, when we invest, we're usually not in, I'd say we're not investing with our fingers crossed. We've done the homework on what kind of risks we're going to see, and we spend time with the founders to make sure that those risks are addressed ahead of the next round.
Yeah, got it. Tell me, give me some insight around this. First of all, that company you mentioned, you talk about a protein. Is it like so? It's like a biotech play, is it? Is it a protein that binds? And because that's quite unique, isn't it? Right?
It is, and it's very exciting. So rare earths in particular are very hard to separate. Typically use hundreds of steps of solvent extraction. High capex, high opex, all those consumables, which can sometimes be recycled. Sometimes they're just dumped in countries that have, they don't have as strong of an EPA with environmental regulation. These are caustic chemicals that are not good for the environment. And we use rare earths everywhere in permanent magnets, in the military. And by the permanent magnets, I mean, hard drives, EV motors, wind turbines, etc. And so the status quo way of separating these is very difficult. You can't really use membranes. So you've got chemical, you've got, membranes, which is sort of by steric hindrance. You're doing kind of physical separation, let's call it. Thermal doesn't work. You can't just like boil the water off. You still have a mix of rare earths. And so this is one particular case of separations. And I have a background in separations, what I was doing at MIT during my PhD. This is one particular case in which bio works very well. These proteins have a very high affinity to basically, it forms kind of a bond, sort of a ligand with these rare earth elements as they're passing through in a column, this particular protein. And as you expose it to lower and lower pHs, it will release different atomic element numbers. It'll release kind of different rare earth elements at different pH levels, we'll put it that way. And so after one or two passes, you can have high purity intra rare earth element separation. So you can have very high neodymium or very high praseodymium quality. And that's not really doable today without, like I said, the hundreds of steps of solvent extraction. So we spent a long time looking at the different technical pathways, understanding what other companies were out there. Some of the companies are using microbes. We here at Voyager, at least, during our diligence, we realized that, the microbes have to, in many cases, they can undergo an evolutionary drift. They can be expensive to feed. They can die off. And so what we liked about these proteins is that theoretically, as long as you don't damage them too much with temperature or extremely low pHs for years and years and years and years, they should be almost infinitely cyclable, I should say, able to open up and close and bind and unbind. So they're a remarkably robust family of proteins, and this is one we're very excited about.
Awesome, yeah. So, what kind of, just at a high level, what kind of rare earth kind of minerals are we talking about? Things like lithium and.
Well, the rare earths are a particular group of elements in the periodic table. Lithium, I think, is number. Let me pull up the periodic table. I usually have this stuff memorized, but. Yeah, lithium's number 3, exactly. And then the rare earths are a different class. And they're sort of like, to give you a few, and they're very expensive on the market today, by the way, in the like tens of thousands of dollars per ton. And by the way, They're called rare earths not because they are scarce in the Earth's crust. They're actually
Yeah.
quite abundant. The
Are
trick
they?
is finding them in high qualities and being able to refine them. So there's a lot
Right.
of value in the in call it the profit pool or the value pool associated to the with to those that can find the high quality deposits, extract them, and then refine them into these intra rare earth element
What
buckets.
are they called then? Just give me the category. Well, I mean, I'm no chemist. We can't go too deep on it, but just, is it something I would recognize?
There's 17 of them, as I recall. They're called the lanthanide series. Atomic numbers 21, 39, 57 to 71. Yttrium, cerium,
Okay.
praseodymium, neodymium,
Okay.
um, dysprosium. So you might have heard of
I've never
typically
heard
in
of
the
any of them.
magnets,
I've got to be honest. What are they used for? What are they used for?
scandium. Yeah, so hard drives, EV motors. They're used in defense. They're used in consumer electronics. They're used in wind turbines. So if you want a really, really strong magnet, you
Okay.
add some rare earths, typically what's called
Ah,
NdPr, neodymium,
okay.
praseodymium, and that gives you very, very strong magnets. Those are called permanent magnets. The alternative are ferrite magnets, and we actually, I should say, we invested in a company that develops an axial flux motor that has a completely new design, and it allows you to use just ferrite magnets, so you don't need rare earth elements. So we've sort of they can use rare earth elements to make the motor even more powerful. But so we've kind of got two portfolio companies that we're supporting, that sort of hedge both bets. But I joke with both founders about that. I mean, we care about what both are building deeply. But yeah, the one motor that could use ferrite magnets without the rare earths, and then we have the other company that's actually producing the rare earths, refining them here onshore in the U.S. And you don't have to just use fresh ores for these rare earths. This company can also take e-waste. So if you have old EV motors, you can shred them down, you can put them in water, and then this company can separate them.
Yeah, awesome. Well, thank you. Just a few things just come to mind. I'm just curious. I read a lot about the funding gap after the challenges with companies. After an A round of funding, right? That next kind of step. Yeah. Well, what's your view on where we are and where this funding gap is going to get kind of closed by? Because I'm sure your success as a company are really determinant on the companies kind of making this
Yeah,
kind of real step, right?
of course. I mean, what we're seeing is that there's real demand for the right kinds of technologies out there, either from corporates or grids or consumers to a certain degree. But that demand, so as you get cheaper to the fossil fuel alternative, and I'm speaking generally here, but as you get cheaper to the fossil fuel alternative, maybe you're already starting out much cheaper to the alternative, or it's done onshore, ex China or ex other regions. Um, there's a real demand for these products. That demand translates into offtake. That offtake can then be used to, in many cases, along with a few other items in a checklist, can be used to raise project finance, which can pay down capex on early commercial facilities after some demonstration at the pilot level. And so there are a number of shops around the world that are doing early infrastructure finance. There's a number of hybrid funds that have popped up in the last couple of years that have recognized this opportunity to invest in early stage technology where the tech has been either mostly de-risked or largely de-risked, um, and can therefore reap the benefits of high IRRs, high project IRRs. And these hybrid funds, what they do is this typically starts at the Series A, Series B, at least for hardware startups that are looking to deploy projects that require, call it more than $3, $4, $5 million worth of capex. And these hybrid funds will put equity, they'll buy some equity in the top co, and then they'll provide debt in the form of project finance or maybe other vehicles in order to pay down that capex. And so there are a number of hybrid funds. There's also large infra players that in some cases are going earlier in order to reap the benefits of a very basic principle: higher risk, higher reward. So this company may be doing its first or second commercial demonstration or commercial plant, so to speak. They've got an off taker already signed up, ready to take that power, take that fuel, take that carbon, whatever it may be. And so they've got sort of repeatable, predictable revenue over the next 10 to 15 years. And what I like to remind a lot of these infra funds is that when solar first started, those that got into solar early reaped extremely high IRRs, into the 40, 50 plus percent unlevered IRRs. And what's happened is more developers have rushed into the quote unquote gold rush, or solar rush. Those IRRs have been whittled down over time. There's less arbitrage, so to speak, in order to extract value from the market, right? And so, some of these new technologies that are coming around, we view them as inevitable. And those that get in early on the infra side and on the project finance side will reap the benefits on the IRR side.
Awesome, yeah. And do you see that evolving and changing? Because it's, is that like something you would expect to see a real positive shift over the next 3-4 years in terms of more financing opportunities around this, as it were?
I believe so, and I'll tell you why. Because I think there's a number of tailwinds that are in our favor. There's a tailwind of national resiliency. There's a tailwind for national security. There's a tailwind for onshored critical minerals, for instance. We want to own our own destiny. We don't want to be reliant on other countries for materials and minerals which are required to defend ourselves in many cases. Right? There is a huge data center boom. And guess what? If you want to go buy a natural gas peaker for your data center, get ready to either pay a premium or wait until 2029 or 2030. And there are some companies in our portfolio that can provide this technology, alternative technologies to those peakers either today or in the next, 1 to 2 years. And so, these other tailwinds, climate is a very broad term when we think about climate tech. And many of the companies that we invest in are experiencing tailwinds in other sectors as well. You don't have to call it climate; you can call it resiliency. And I know that over the last 6 months, there's been a lot of semantic gymnastics happening where funds are calling climate something different, but we frankly don't care what it's called. We just again want to see really strong founders with great unit economics disrupting giant markets where the offtake will be there if they build what they intend to build.
Awesome. I can tell you like your job a lot, Leo. What's the best thing about it? Like when you think about your years, your career, quite a unique career you've had. The McKinsey and the PhD. The technical research route into investing. Well, what's the thing that gets you out of bed every morning?
Yeah, I was also a founder once and an operator as well, and so I have empathy for those founders that are out there building these companies. It's a lot of hard work. At Voyager, most of us are founders as well, former founders, and so look, I mean, what gets me out of bed is I don't know if your listeners are familiar with ikigai. It's a really great Japanese framework on how to live your life, but I really feel like I'm at the center of my ikigai. I'm doing what I'm good at, what I feel like I'm good at. I feel like I've been training my whole life to do this job, doing what allows me to put my kids through school and pay the mortgage. So do what you can get paid for. What is it? Do what you love. I genuinely love doing this work. I love machines. I love thinking about the technicals. I also really love thinking about how to actually get things built in the world and do what the world needs, which is the final sphere of the ikigai. And I think that this is I was also I'm Jewish. I was raised Jewish. There's a tenet in Judaism called tikkun haolam, which means to repair the world, literally. And I'd like to think that when I'm older, I can look back and say, yeah, I did a lot of work alongside the very hard work of the founders, of course, to try to make the world a better place while I'm here. And so, I do what I do because I think it is, and it's going to continue to be extremely lucrative. These are companies that are bringing groundbreaking technologies in to disrupt the status quo. At the same time, they're also going to have an impact. To maybe round out your question a little bit more, I love working with the founders. I have a lot of empathy for that role. I was in that role. I supported another founder when I was an operator at a startup that I joined after graduate school. And I like to approach things with a problem solving mentality. So rather than point out what they're doing wrong, like, hey, how can we fix this together? And look, I also am fully aware, I know that's a VC trope, which is like, tell me how I can be helpful, right? But I genuinely, and at Voyager, I should say as well, like at Voyager, we really do want to support the founders. We get it, and we want to be there for them. Whether that's customer introductions, a deck review, data room review, investor introductions, you name it.
Yeah, no, awesome. No, it sounds awesome. And I would have thought as well, like your technical background as well. I speak to a lot of investors, but you clearly get a real deep grasp, like that deep grasp on the technology, right? That clearly
Yeah.
really appeals to you as well. Do you feel that like that gives you a kind of edge in the world of VC?
Yeah, I do. In fact, no hot takes to my banker and private equity friends. They're wonderful. They're spreadsheet magicians in many cases. But when I was at McKinsey working with, PE funds, crossover hedge funds, growth equity funds, doing diligence on different startups, that's when I got the idea to take the diligence skills that I had learned at McKinsey and marry them with the technical skills to go into venture. I decided ultimately, rather than tell other funds where to invest capital, I wanted to do it myself, take on that risk. Maybe because I grew up in Las Vegas, I wanted to gamble a bit. But this is more informed gambling, I should say. But yeah, I realized when I was on those diligence teams, there was a lot of education required. Okay, this is how a battery works, or like this is, this is what the company is doing. This is why, you're, these are the first principles. This is as good as you can do in this technology, maybe with respect to some kind of a thermodynamic minimum or something, right? Like, and we would shoot down some investments, or at least present the facts that portrayed why the investment wasn't a good one, or we would do the opposite. And a lot of the time, it came down to the techno-economic analysis, what we call the TEA. That usually defined whether the company was going to be a good one or not a great one. I mean, there are other factors as well, but I think in my experience as a VC, I've found that having that technical mindset has been an edge for me personally. Being able to connect with the founders at the deep level, and supporting the CTO, the CEO. That said, there are also a lot of other folks in venture and in climate as well that may not have, as strong of a technical background. Maybe they just had a bachelor's in engineering, or maybe they studied something else completely, but they're very good at first principles thinking and problem solving. And so there are other really formidable investors out there as well. But for me personally, I do find that it gives me an edge and helps me win confidence and support from founders, especially in competitive rounds, which we've won at Voyager. And the same is true of my colleagues at Voyager: Sarah, Sierra, Matt, Jake, Nare. They've got deep expertise on in some cases a PhD like me, or in some cases depth in certain markets, whether it's finance or bio. So yeah.
Yeah, how much of it is competitive these days? It's funny, I've never thought of that. Like competitive rounds when,
Oh yeah.
yeah, is that does that happen a lot as opposed to non-competitive?
Yeah, of
Yeah,
course. Yeah,
right. Yeah, yeah.
absolutely. 100%. Happens all the time. And so, in many cases, during diligence, you both have to diligence the founders. I don't want to use very transactional language here, but they have to sell you, and in some cases, you also have to sell them. Why are you going to take our check versus somebody else's? And I believe it's because we're founders ourselves, many of us. We have over 60 years of cumulative climate tech experience. We really do support. We love working with founders and supporting them, like I said. And that's something I realized very early on in VC is, why would a founder take our check versus another fund's? What differentiates the climate funds? And so having a strong narrative around that is important. And yeah, there absolutely are competitive rounds.
I thought they took all checks.
No, 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 no. No, no. Look, I mean, it just comes down to the fact it's a dilution question, right? If let's say the team is raising a $10 million round, but there's $20 million worth of interest, and the company is valued in a certain way, right? Like the valuation. Sometimes in competitive rounds, the valuation will start hopping up, and the funds try to outbid each other. But there's a certain point at which it's going to be very difficult to justify at the next round
Yeah.
why the startup is worth that much. And so that's why, one of the reasons I joined Voyager and one of the reasons I love being here, we're really objective and price disciplined. When that thing starts to happen, we're like, you know what, we don't believe the company is worth this much, and so we're going to bow out. But that absolutely happens. Founders don't take all capital that comes through the door. There's different colors of capital, there's limited room in many rounds.
Yeah.
Oversubscribed rounds happen all the time.
Yeah. No, great stuff. Look, I could talk to you. We could talk for hours about this, couldn't we, Leo?
Yeah.
But I know you've got a day job to get on with. So thanks so much for coming on. It's been fascinating. A really interesting kind of discussion, leveraging a lot of your kind of knowledge and expertise about some of these kind of future trends and how you approach things and what's hot and what's not hot. So really enjoyed it. Thanks so much for coming on.
My pleasure, Simon. Thank you for having me on the podcast.
No, absolutely. And to all the guests joining in, it's been a really good discussion. Hope you enjoyed it, and we'll see you on the next show.